Day trading the NAS100 provides a high-speed rush. It moves fast, the swings are huge, and the adrenaline is constant. That speed comes from its makeup. The NAS100 tracks the 100 largest non-financial tech companies. Because it is heavily weighted in tech giants, the index reacts violently to news events and earnings reports. Look at this table comparing the NAS100 to traditional Forex markets. Currency pairs move steadily on macroeconomic cycles. The NAS100 is high beta and deeply sensitive to news, meaning it routinely posts extreme daily point ranges. That massive point range is exactly what attracts retail traders looking for big profits. But those wide swings routinely demolish generic support and resistance strategies. The market will frequently push past an obvious level to trigger breakout orders and hit stop losses. This engineers a liquidity sweep, trapping retail traders on the wrong side before price violently reverses direction. To survive this, some traders turn to inner circle trader, or ICT, concepts. Instead of looking for retail patterns, this framework tracks footprints of large institutional orders, the smart money. But there is a heavy trade-off. Mastering ICT concepts requires grueling discipline and a steep learning curve. It is a rigid, rules-based system. So the question is, does the massive mental investment required to learn this system actually generate a positive return on the NAS100? Let's evaluate the 4 phases of the framework. The first requirement is building a higher timeframe bias. Before you ever look at a 5-minute chart to execute a trade, you have to establish the daily and 4-hour narrative. You define the macro trend first. This process aligns your thinking with the massive institutional order flow. You are locating the overall tide so you don't end up swimming against it. The trade-off is time. This demands significant pre-market preparation. It also means you must sit on your hands and ignore incredibly tempting setups on the 1-minute chart if they conflict with that daily trend. Skipping this step turns fast-paced day trading into mathematical gambling. The higher timeframe narrative is your only anchor. The second phase restricts your execution to very specific time windows. This timeline highlights the silver bullet window. It dictates that you only look for entries strictly between 10 a.m. and 11 a.m. Eastern Standard Time. Waiting for this specific hour lets the chaotic volatility of the initial New York stock market open burn itself out. By 10 a.m., the false moves settle, and a clean directional expansion usually begins. This is a drastic limitation. If you work a standard job or live in conflicting time zones, you physically cannot trade this specific edge. The window does not flex. In this framework, the time you look at the chart dictates your success heavily. The when matters just as much as the what. Phase 3 is the mechanical entry model, specifically designed to fade those false breakouts. First, the sweep. You wait for the price to intentionally push past an old high or low. This traps retail traders who buy the breakout right before the price reverses. Second, the market structure shift. That reversal has to be aggressive enough to break the previous swing low, confirming the short-term trend is broken. Third, the gap. The sheer speed of that reversal leaves an imbalance in the price action, a fair value gap. This specific sequence gives you a mathematically logical entry point at the gap, allowing you to place a surgical stop loss safely behind the peak of the initial trap. But here is the heavy cost of precision. Frequently, the price will run straight to your profit target without ever pulling back to trigger your entry. You will predict the market perfectly and still make $0. You have to accept the pain of missing out in exchange for the safety of precision. The final requirement is protecting your capital through dynamic risk execution. You must calculate your position size individually for every single trade. Your lot size is determined by the exact point distance between your entry and your structural stop loss. This directly counters the common retail habit of using fixed lot sizes, regardless of how the market is behaving. By adjusting your size, you ensure you never risk more than 1% of your account. That stays true whether the NAS100 is having a tight 20-point session or a wildly volatile 100-point day. The catch is that you have to do real-time math right as the setup forms. It completely eliminates the ability to click buy based on a gut feeling. But that proper dynamic math is the only shield robust enough to keep your account alive through the massive intraday swings of this index. Trading ICT on the NAS100 is an incredibly potent edge. However, at its core, it is a game of extreme weighting, not a game of constant action. This scorecard breaks down exactly who is built for this approach and who will lose money trying it. If you are a thrill seeker, prone to overtrading, or cannot monitor the US morning session, this system will quickly drain your account. This edge is a perfect match for intermediate traders willing to act like snipers. You have to build a daily narrative, stick to your time window, and possess the emotional control to end the day flat if a setup doesn't form perfectly. The ICT framework doesn't tame the volatility of the tech index. It simply provides the rigid rules of engagement you need to survive it. Attempting to learn these mechanics in a live NAS100 market will inevitably lead to blown capital. The index moves too fast for beginners. You only develop an eye for true order blocks and fair value gaps through extensive backtesting and forward testing in a simulated environment. When you are finally ready to execute, trading gap entries requires zero friction. You need a broker that offers 0.0 pit spreads, so your orders trigger exactly where you plan them. To practice this, open an NX1 demo account on the FXNX platform. You can identify these setups and execute dynamic risk sizing completely risk-free before ever putting real money on the line. Precision and patience are your greatest assets. Build your consistency in practice so it pays out in reality.